Good morning, traders and investors. Roger Scott here. It's about 8:05 in the morning. The market is a little bit higher this morning. We'll get into all of the details. Before we get into all of the details, make sure to like this channel, subscribe to our Telegram channel. I post free trades there from time to time, and we're getting ready to launch some day trading goodies. Don't miss out. rogerscott.com/Telegram or below this video. Do not miss out on that. Also, I've opened up my VIP room for the summer for free, no cost. Today is Thursday. That means it's happening at 11 a.m. Do not miss out. You're going to have a lot of fun there. So, and follow the link. You could find them either above or below this video to my VIP room, to these videos, and to my Telegram channel. Now, let's get into all of this. Actually, I want to start off today by giving you a little bit of a lesson. And we'll circle back into the analysis, but I want to start off because this is a really good opportunity to teach you guys something. So these are all the major sectors. I want to show you the basic premises of relative strength. Now, as you can see here, these are, you've got the, here, let me go to a table. So you've got SPY, QQQ, the major sectors, the Russell 2000, the energy, consumer staples, utilities, industrial, healthcare, material, communication. So you have some major indices, and then you have sectors throughout the indices. So this will give us a really good idea of where we stand right now. So this is what, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. And typically what we do is we look at all of these to determine strength and weakness to see which ones are moving. Now, in this case, if you watch this closely, you will see that they're all moving down. Look, down, 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 down. Everything is moving down. So the question becomes, Roger, which one is stronger than the other? Which one should we put our money in? They're all moving south. Well, there's an answer to that question. And the rule of thumb is really, really simple. And it's a little counterintuitive. Most folks who are starting out would think that the weaker the market gets, right? That the more it's down, or the more the sector has lost, the more it'll gain because it's cheaper. It's absolutely not how it works. It actually works completely the opposite. The way it works in real life, and I could tell you this from years and years, not years, decades of backtesting and real life trading and doing all this for decades. And I've been doing this for decades. The strongest sectors, the sectors that have the strongest or the least amount of weakness, are usually the first ones to recover and bounce back. So if you're looking for pullback opportunities, or if you're looking to get a deal, you're looking to get a deal, markets are cheap, you want to get a deal, they're pulling back. A lot of traders will end up going for the real estate or technology or the utility sector, because look at the utility sector. I mean, it's been beaten down to death. But the truth is, the ones to recover the first, and the ones we're going to be talking about today for our ETF pick, is going to be either energy or healthcare. Why? Because they lost the least. That means if they're losing the least when markets are going down, they're probably going to gain the most on the way up. So again, I wanted to show you this because sometimes, most of the time, it's not that hard because you still have some sectors moving up while others are moving down. But in this case, they're all moving down. So it's a lot of folks are saying, well, where do we put our money right now? Where do we put our money? You put your money in the sector that's going down the least, and we'll circle back into that when I do the ETF section. But I wanted to give you this little educational sector analysis today because it's very, very helpful to guide you where you should be focused and where you should be staying away from or paying attention from. Now, let's get back into the market. Now, as I mentioned earlier, the market is up right now. It's not down, but this is random. 50 points on the Dow, 42 points. This is like the Dow being up or down 90 points. It's not very relevant. I'll tell you the two things that are relevant. The fact that the bond market is breaking lower. I thought it was going to hold here, a little bit bounce. Didn't want to do it. This falling knife is getting kind of deep, and it does. I know the Fed is saying we're stabilizing, interest rates are not going to go much higher. Well, this is telling us that that's not true. Matter of fact, we just broke through key levels here. Let me go back to a one-year chart. I wish I could do this like in Thinkorswim. I'm going to switch over to Thinkorswim pretty soon for my videos because it's just easier to navigate for me. But anyways, you could see right here how we're losing steam. And if we're losing steam right here, the odds are we are going to go down here. And this puts a lot of pressure on technology, communication, consumer discretionary stocks, retail stocks, because this means higher rates. And also this puts more pressure on the utilities market, because utilities and bonds compete for yield. And when bonds go lower sharply like this, that means yield is going higher on interest rates. And if yield is going higher on interest rates, people are going to be dumping utilities, because people buy utilities for yield, right? They're not buying utilities for high flyers. It's not Microsoft or Intel or Nvidia, right? So they move out of utilities and they move into interest rates. That's why utilities right now are in the crapper so much, and they're breaking down. And if the bond market continues breaking lower, it's only, especially at a speed like this, it's going to put more pressure on the utility sector, which make up a good chunk of blue chips. Now, we had housing starts yesterday. We had industrial production. The data was mixed. It wasn't great. It wasn't bad. It was okay. FOMC, I'll talk about in a minute. That was exactly what I thought. A lot of them still think we need to raise rates. Today, we've got jobless claims in manufacturing. Jobless claims has been a complete nothing burger unless it's near 300,000. It'll probably be near 250,000, which 231 average is completely on par. This is not even worth talking about if it's not close to 300,000. Then you have the manufacturing index, and then you've got earnings on retail. Today, you've got actually earnings on Applied Materials, Ross Store, and Walmart. Those are two major retailers. Target did okay. Let's look at Target real quick. Target did okay yesterday, but all in all, I want to show you this. Look at the downtrend on Target and look at yesterday's trading action. It huffed and puffed, and then it went down the entire day. This is Target yesterday. It lost intraday 7 points. So I'm not really happy about this, and I drew this little arrow, and I think this thing is going to come down. I don't think there's going to be much upside. I think Target's going to be coming more down to this target. So I'm not really happy with what I'm seeing right now in the market. Now, volatility via the VIX, and no, it's not broken. It's just used to very high readings. It looks like it's getting ready to break up. If the news today is not better than expected, let's look and see how Walmart is doing right now. Walmart is positive. That's good. That's good. Let's look at Applied Material. That's the other one. Applied Material is up. That's not bad. And what was the other one? It was, let's see here. Here it was. Let's go back. Walmart, Applied Material, CBOE. Here, let me just quickly tell you which one it was. It was Ross Store. Let's look at Ross Store. Excuse me. I'm all over the place. And Ross Store. So far they look positive. Let's see how they look when they open. And I don't know if earnings are before the opening bell or after the closing bell. But retail, we have to keep an eye on the retail sector today. Retail stocks, let me see if I could find the retail sector, XRT right here. Yeah, it hasn't been doing well at all on an intraday basis. Look at that. And it looks like it's coming down like the rest of the sectors. Now, it is oversold. There's a lot of oversold, but I'm not liking this. And the fact that most markets or most indices are looking like this is not making me happy, because earnings are, for the most part, behind us, and there's no major catalyst. The bond market's breaking down lower, and implied volatility via the VIX is not looking all that great. So we have to be very, very, very cautious. Matter of fact, I'm going to add XRT to this. Let me do that right now. What am I doing here? What am I doing here? Here. I'm going to add XRT here. XRT here. Capital XRT. There we go. And we're going to save as new. There we go. All right. So we should now have XRT as well here. Let's see. See, we have XRT. Yeah, there it is. There it is in the middle. Yeah, so retail is right here on the cumulative basis. On a weekly basis, retail is in the middle. But again, be cautious. As far as the broad market, let me just kind of quickly go over this and get into the ETFs with you. But again, I wanted to give you a little education session today. So participants digested minutes from the Federal Reserve. We'll talk about that in a minute. There's fresh indication of weakness in China. Oh boy, don't hold your breath. The minutes from the Federal Open Market Committee revealed a split among Fed officials regarding the necessity of further interest rate hikes. Some participants voiced concerns about potential economic risks from excessive rate hikes, while majority, continued to prioritize the battle against inflation. Most, I'm going to read again, most, you see majority, continued to see significant upside risk of inflation, which could require further tightening. It's that simple. Don't read more into it. We're going to go interest rates higher. S&P dropped to a 5-week low. Blue chips dropped to a 4-week low, which means there's higher relative strength because it's a 4-week low versus a 5-week low. And Nasdaq notched a 6-week low. 5-week low, 4-week low, 6-week. 1.5 months is, 7-week low. What am I saying? So the Dow, the blue chips are obviously stronger than expected. Economic data was mixed yesterday. Permits came out okay. Industrial production came in stronger. The fact that there's not going to be an interest rate hike is now declining. It's an 86% chance from a 90, and I think it may go a little bit lower, but I think it'll stay at about 75 to 90% because I don't think there's going to be an interest rate hike, even if the Fed is going to hike rates. It's just it doesn't have to be in September. It can be in October. It can be in November. It can be in December. Again, watch Walmart, Applied Material, and Ross Store, chip stocks, and retail sales. That's communication, consumer discretionary, and tech, those three bubbles. Manufacturing index is coming out, jobless claims, which is a nothing burger. Europe is down. They're concerned about the fact that U.S. and central banks may be hiking rates again. Losses in construction and basic material stocks did not hold the market higher. China closed higher, supported by robust performance in technology stocks, but concerns over Chinese economy and its precautious debt burden persisted. Reuters reported that Zhongzi Enterprises, informed its investors about a liquidity crisis and conducted debt restructuring. Property market is turning down, and China is the second biggest economy. Japan closed lower. Data on Thursday revealed that the country logged an unexpected trade deficit. Also, exports experienced a decline in July for the first time in 2.5 years. Folks, underscoring worries about a potential global recession. I'm telling you, it looks a lot like 2007. Now, we may see some upside in software-related stocks today, especially in the morning, because both Adobe and Cisco, this is networks and this is software, had good earnings. They got upgraded. So if we see software stocks like Broad Technology slump today, oh boy, it's bad. And keep your eye on retail as well. Now, the number one sector that I'm liking right now, and I'm going to tell you what it is right now. I like energy and healthcare, but I really like energy and I really like healthcare. Let's look at both. So energy is looking up. It's still holding up a lot better than most. And healthcare, these are very defensive-friendly stocks. It's not looking as good. It's bouncing off of this low. So I would continue being focused on energies right now. I wouldn't even think twice. It's outperforming the market. I'd go to the 9:15 expiration. Implied volatility is not really all that different from historic. I would be looking at the 89 strike price, maybe the 88, 89, right here. Here's the sweet spot right there. And if you behave yourselves, you can offset it with the 92 if you can get 50 cents for it. Let's keep that between us, all right? That's my option pick. Now, before I let you go, I've got a couple of small caps for you. A lot of folks have been making money with our day trading picks. So here's one. The stock is up right now. It's up only 20% from yesterday. And if you look at it on an intraday basis, it opened up. It's been coming down. Typically, these stocks, they spike and they come down. They spike and they come down. I'm expecting the stock to come back down. I would not be trading the stock to the upside unless it broke the $6 level. And I don't think it's going to break the $6 level, but that's where the resistance is right here. I would think it's going to come down, so I would be shorting it if it breaks the 440 level. That's the first stock. The second stock is HE. This stock is down right now, 13%. Look at this thing. And it looks like it's been really, really coming down. On a 1-month basis, it came down. I'm looking for this stock to trade above, here 5 days. Where are we? Right here. Here we go. I want to see it trade above $17. If it doesn't trade above $17, and it's going to get volatile, I'm not interested in it. And $17 isn't all that much, by the way. Not all that much for this stock. Look at the volatility. But I want to see it go higher. It's at 14. I want to see it trade higher. If anything, maybe buying it around the 15-ish, 15 level, but I want to see it break higher before I buy it, not lower, higher. Again, these are stocks that are really showing strong volatility right now. But they should be moving up. This one should be moving up. If it doesn't move up, forget about it. Now, before I let you guys go, and don't forget, subscribe to my Telegram channel, rogerscott.com/Telegram, or follow link below this video. Make sure you join my VIP room at 11 a.m. today. Don't miss out. Now, the response so far has blown me away. It really has been amazing. So I'm going live today again at 1 p.m. Eastern time for anyone who wouldn't make it on yesterday's session. We had a great attendance yesterday. And you know I'll have a very special treat for anyone who comes. I always do. So on Wednesday, yesterday, I gave a stock that surges like clockwork over a period starting on August 16, dating back 28 years. That's right, I did. And today, I'm going to give you my five top seasonality stocks for the second half of August. Why not? I love you guys. I'm also showing off my patent pending software that's been able to achieve over an 81% win rate this year in this crazy Michiganer nutty market on live trades over the past 8 months. Not bad, right? And get this, I also have a special $500 surprise lined up for a few lucky folks. What a day. I can't wait to see everyone there. 1 p.m. Eastern time. Don't miss out. Subscribe to Telegram. Comment below these videos. Join our channel. And most importantly, thank you for watching these videos. Bye, guys. I'll see you at 1 p.m.